Now let's get to a big warning from a big bear. Investor Jeremy Grantham says the stock's super bubble that he warned about previously has yet to pop. The GMO co-founder sees more trouble ahead due to what he calls a dangerous mix of overvalued equities.
Today, we're delving into a crucial topic, the stark predictions made by the renowned investor Jeremy Grantham regarding a potential and imminent market collapse. We find ourselves on the precipice of a bubble ready to burst, with a 70% likelihood of a market crash in the near future. Grantham's cautionary words carry significant weight, particularly given his reputation for going against the norm and accurately predicting market bubbles. He draws parallels between the current financial climate and past market collapses, such as the 1929 Black Thursday crash that wiped out $14 billion in market value in a single day, and the burst of the 2000 dot-com bubble, both of which led to major economic downturns. With the 2021 market experiencing a 10% dip, investors are understandably nervous as the U.S. stock market approaches record highs once again. Grantham sounds the alarm about its concerning high valuation.
You are well known in the investment world for saying that sometimes there are bubbles and bubbles should be avoided. Do you think we're in a major bubble now, right now in the United States? And do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe...
It may start in 2023.
In the face of a potential market downturn, investors may wonder about the implications and how to not only endure, but also prosper during such times. Jeremy Grantham offers a distinctive viewpoint, advocating for the acquisition of elements designed to withstand and thrive amid a crash. His approach revolves around intelligent asset allocation and the identification of potential opportunities, even in non-declining market conditions. In our video, we will delve into Grantham's insights, providing actionable advice on safeguarding and enhancing financial assets during periods of economic instability.
I suspect that they will once again dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline.
Jeremy Grantham has recently issued a warning about investments in the U.S. stock market. He emphasized the possibility that, under specific challenging conditions, the S&P 500, a key indicator of the U.S. stock market's health, could experience a significant decline, potentially surpassing a 50% fall.
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
Grantham expresses deep concerns about the U.S. stock market, particularly focusing on the S&P 500, citing several key economic factors. Firstly, he highlights the massive U.S. national debt, currently standing at $33 trillion, as a potential destabilizing factor for the economy. Grantham suggests that high debt levels could impede economic growth and shake investor confidence. Additionally, he points to the impact of rising interest rates in the U.S. Higher interest rates could lead to increased borrowing costs for businesses, potentially reducing their profits and adversely affecting the stock market. Grantham also cautions against unsustainably high yield levels, indicating that current optimistic investment return expectations may be unrealistic, hinting at a possible market adjustment. Grantham extends his concerns to encompass the real estate and mortgage sectors. He notes challenges in the U.S. housing market, which experienced a significant drop in home values only during the 2008 financial crisis. Currently, the housing market faces a shortage, resulting in increased demand that surpasses the available supply of properties for sale or rent. This, coupled with rising mortgage rates and declining housing affordability, intensifies competition for limited housing options. There is a noticeable slowdown in home price growth year over year since 2022, suggesting a potential cooling down or deceleration in the housing market.
I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. And people never get it. People never forecast it. And along with the recession comes a drop in profit margin.
The potential challenges in certain sectors may have broader economic consequences, impacting both consumer confidence and financial markets. This is a significant factor contributing to Jeremy Grantham's deep concern about the U.S. stock market, shaping his currently bearish perspective. Here's an overview of his stance and some pointers on adjusting your investment strategy if you align with this cautious view. Grantham's key analysis is centered on the Russell 2000 index, comprising the smallest 2,000 stocks in the Russell 3000 index and primarily representing small-cap stocks. These stocks are often seen as a reflection of the overall U.S. economy due to their focus on smaller domestic companies. Grantham highlights a noteworthy aspect of the Russell 2000, indicating that a substantial portion consists of zombie companies, firms struggling to cover interest payments without incurring additional debt. Approximately 40% of these companies are not turning profits while carrying record-high debt levels. In addition to his concerns about the Russell 2000, Grantham maintains a cautious view of the S&P 500, a comprehensive market index including 500 of the largest U.S. companies. He anticipates a potential decline to below 3,000 points from its current level of around 4,500 points. In more severe scenarios, he even considers a drop to 2,000 points as a possibility. These perspectives underscore Grantham's apprehension about the market's health and inform his bearish outlook on its future trajectory. Despite the potential for such a drastic fall requiring a confluence of significant problems, Grantham directs attention to what he calls the Magnificent Seven, the 7 largest U.S. tech companies by market cap, including Apple, Microsoft, Amazon, Google, Nvidia, Tesla, and Meta. According to Grantham, these tech giants currently serve as pillars supporting the U.S. market and exerting influence globally. Their robust earnings and high stock market valuations, partly fueled by the rise in private equity, have propelled them to achieve multi-trillion-dollar market caps. Grantham emphasizes that without the performance of these tech giants, the S&P 500 would not have posted positive results for the year. However, he expresses concern about the extraordinary concentration of the market around these 7 companies. This focus raises several questions about the future paths of these tech giants. Grantham speculates whether they will sustain their growth trajectory, maintain a significant share of the global market cap, face regular challenges, or enter into intense competition with each other, potentially affecting their profit margins. The ambiguity surrounding these prospects contributes to broader market uncertainty. In response to these concerns, Grantham advises investors to look beyond the U.S. market.
So if I said to you, look, I'm not that wealthy, I have $100,000, I'd like to put it somewhere where I'm not going to lose it, what would you recommend the person? Just an index fund or something else?
No, I think a global index fund that had most of its money outside the U.S. And if they were up to it, I would say only invest outside the U.S. for the time being. Because this overpricing in the market is mainly a U.S. event. The markets outside the U.S. are not particularly overpriced.
Grantham advises investors to explore well-developed markets such as the United Kingdom, Japan, and Europe, where he identifies more attractively priced investment opportunities. He underscores the importance of investing in quality companies to successfully navigate market volatility. Grantham equates quality with a company's fundamental strength and stability, emphasizing that these aspects have been chronically undervalued in the market for decades. Drawing a comparison, Grantham likens the concept of quality to AAA-rated bonds, widely regarded as the safest due to their low default risk. He points out that while such bonds typically perform well in bear markets, they might lag in bull markets due to their lack of excitement. In contrast, during bull markets, investors tend to pursue more speculative and sensational stocks like Tesla or popular meme stocks, which promise quick returns. However, Grantham argues that, in the long run, quality-focused companies, exemplified by Coca-Cola, usually deliver more consistent results. Breaking down Grantham's concept of quality in investing, he highlights the significance of low debt. Using the analogy of lending money to a financially stable friend, he notes that companies with low debt are seen as less risky, better equipped to handle economic downturns without the burden of large debt repayments. For instance, a company with high debt, Company A, could face financial struggles in tough times, whereas a company with little or no debt, Company B, is more resilient. Grantham emphasizes the appeal of high, stable returns, as investors prefer consistent and robust performance. He suggests seeking out companies with a history of delivering stable financial performance, citing Coca-Cola as a prime example, with its long-standing history of steady returns driven by consistent demand for its products. Quality companies, according to Grantham, are typically associated with reduced risks and less price volatility. While riskier stocks may be tempting for their potential high returns, they also come with greater unpredictability. In contrast, quality stocks offer a more stable and reassuring investment, especially during market downturns, where they are less likely to plummet dramatically compared to their high-risk counterparts. In essence, Grantham's investment philosophy revolves around focusing on a company's core fundamentals rather than getting caught up in fleeting market trends. He likens this approach to choosing a dependable, well-constructed vehicle over a flashy sports car. Investing in high-quality companies characterized by low debt, consistent returns, and lower volatility can lead to more reliable and sustainable long-term gains, underscoring the enduring value and often overlooked potential of quality as an investment strategy. And that's it for this video. Let us know your thoughts in the comments down below. Thanks for watching till the end. Before you go, make sure to like and subscribe and click the notification bell to trigger YouTube's algorithm and see more of our videos on your homepage. Thanks for watching and see you next time for more interesting videos like this.